Hi guys! Welcome back to the May update of my dividend growth portfolio. In this portfolio, I currently have 119,000 euros split between 19 stocks and 3 ETFs. My long-term plan is to grow it to over 1 million euros over the course of the next decade or two and to generate a nice and steady stream of passive income along the way. And after the pretty weak performance of the last month, May actually was my strongest month of the year so far. However, there are some signs that warn us that this rally might be over soon and that the economy, particularly in the US, may still be heading towards more turbulent times. So in this video, I will show you exactly what I mean with this and how I will act now. And of course, I will also show you my new buys and the dividends I received in May. I also have an announcement to make at the end of the video that I'm really excited to share with you. But first, let's look at the overall portfolio performance. And if you're new here, my name is Florian. Thank you for joining me today. So I started into the month with a total portfolio value of 111,000 euros, split between 24,000 in ETFs and 86,000 in stocks. By the end of May, the total portfolio did increase by 7.8% to 119,000. So after the last 2-week month, it came back to the growth path. My stocks went with 8.4%, a little better than my ETFs with 5.7%. It is also a bit better than the S&P 500 that still had a good month with 5.5% total returns. This is also pretty much the same performance that the MSCI World had in the end. The Nasdaq with 7.8% also had a great month and similar returns as my portfolio. So my portfolio is still a bit below the levels it had in February, but at least the trend is pointing upwards again. And if you're now wondering why my S&P 500 ETF shows a monthly performance of almost 6.9% compared to the 5.5% that we just saw, there are 2 reasons for this. The first one is that I show the performance in euro here, so it also includes the currency effects. And second, I have an ESG selected S&P 500 instead of the regular SPY. Over the long run, the performance of the two is pretty much the same, but on a weekly or monthly basis, it might be a little bit different. I also have a regular savings plan running on this ETF, so I dollar cost average into this every month. As I also tend to buy shares every month, this also gives me a very nice direct comparison to my stocks because the buy patterns are basically the same, although on a different level. And the total performance this has produced since the start of my portfolio is actually quite a bit better for my stocks compared to the S&P. While the ETF produced 16.6% returns, my stocks overall had 23.5%. And this is the total performance. So it also includes all dividends that I received in both cases. And because I want to see my real performance, I use the net dividends here. So the taxes I have to pay are already subtracted from the total dividends. This might not be the best comparison because it hurts my overall performance a bit on paper, but I still like it better because it shows how much money I really earn. And this is what really matters in the end, right? Right now, the dividend payments also only make up a smaller portion of my overall returns. When we have a look at what drove the markets in May, we see that except healthcare, all sectors are up by a decent amount. There are some exceptions like the big red apple and Buffett's Berkshire Hathaway, but overall we had a market-wide rally. And this rally has also pushed the S&P again close to its all-time highs. It is now roughly on the same level as last November again and has only about 3% more to go until it reaches new all-time highs. The VIX, the volatility index, has also pulled back again and is now well below 20, which indicates that the market doesn't show any increased volatility or risk, but has reached a pretty much stable and stress-free zone again. But despite this, or maybe even because of it, I am not convinced that the worst is over yet. Because I think that the markets might be overly optimistic right now. Let me show you why. The trailing 12 months PE ratio of the S&P according to Guru Focus is at above 27 right now. This is on the upper end of the average value of the last 10 years plus and minus 1 sigma or standard deviation. That is basically a fancy way of saying that in 68.2% of the time, the S&P was within this blue marked area. And every time it went above or below this line, there was actually a high chance that it returned to more normal values sooner rather than later. And the last time we had a huge spike in the valuations in 2021, the S&P had a pretty bad year in the next year in 2022, where it declined for the majority of the year. Now, we are nowhere near the levels of 2021 yet that reached up to a PE of 41 briefly, but it's still well above the average value. And the regression to the mean or mean reversion is a statistical theory that suggests that all outliers will eventually return to their long-term averages. When we look at the second indicator that I like to use in combination with the VIX, the MMFI, which shows the percentage of stocks above the 50-day average, we also see that right now almost 70% of stocks are above this average. And this is pretty significant because it has never stayed at this level for long. It also doesn't help that the recent rebound was mostly driven from private investors, while institutional investors, here the smart money, have mostly stayed on the sidelines. Now, I don't want to be a crash prophet. And even though these statistics show quite high values, there is nothing stopping them from going even higher still. History just shows that it will return to the average eventually, but not when this will happen and how high stocks will rise in the meanwhile. In fact, it doesn't even mean that a crash is coming. It could very well result in a stagnation that will eventually return these values to more normal levels when the fundamentals catch up. All this is also pretty much only true for the US market. The Euro Stoxx 600, for example, still have a trailing PE of 17.7, so it is almost exactly 1/3 cheaper compared to the US market. So what am I doing now? First of all, I will not stop buying stocks. I will keep on buying companies that I like and from which I think that have a strong and resilient business model. I will also take a good look at the valuation, even more so than I already do, and I will not buy any companies of which I think are overvalued, even if I like the business. I'm looking at you, Palantir and Snowflake. For example, earlier this month I bought 23 new shares of Novo Nordisk for 1,417 euros. This has brought my position size to 3,500 euros now, which still leaves a bit more room for me to further increase this position. Right now, I'm down by 8% with this position in total. But I just started this position in March with an anti-cyclical investment, so I am not worried at all about this. When we sort this list by the total value, we also see that with Dassault Systems and Surgical Science Sweden, and to some degree also JD.com, there are also 3 non-US companies that are still smaller positions in my portfolio that I'd like to further increase. But I am not seeing any concrete short-term catalysts that could push these stocks higher soon, so I am not in a hurry to do so. Then there is also still the matter of Texas Instruments. I've talked about selling them a couple of times already. Last time I said that I might want to observe their performance until the end of the year before selling them. But over just the last month, the stock is up by over 17% again. This has brought the valuation to pretty high levels now, so it might be time to pull the trigger on this. But as they are my 3rd highest dividend payer right now, this will definitely have an impact on my dividend payments, at least in the short run. So let's see. Usually I am not that indecisive with my decisions. I mean, I had no problem selling out of Rio Tinto earlier this year. But with Texas Instruments, I find it strangely tough to come to a conclusion. But speaking of dividends, May was a pretty good month for me in terms of dividend payments. JP Morgan started the month with 32.47 euros on the 2nd of May. ASML paid 10.95 euros on the 6th, and DHL, my overall biggest dividend payer right now, paid me their annual dividends of 181.30 euro on the day after. Next came Texas Instruments with 37 euros on the 15th, and Dassault Systems closed the month on the 29th with 11.31 euros. So in total, I got 273 euros of dividends in May. This is not quite as much as what I got in April, but it still made my second quarter already my best quarter ever in terms of dividend payments. In terms of stock allocation, my portfolio now looks like this. The biggest change is the increase of Novo's share that came at the cost of Ahold Delhaize and Danaher. So that is the status quo as of today. But what am I planning for the next month? First of all, June will be a bit more quiet than usual from my side. May, June and also September are pretty much the busiest months of the year in my regular job. And in the coming June, I'll be on a business trip for 2 straight weeks. So between this and my family, I'll probably not be able to record a video every week. I hope you can forgive me for that. I know that the YouTube algorithm probably won't. I'll make it up in July though, because I have some vacation there and more time to think about my investments. And speaking of the algorithm, if you like the video so far, it would help me out a lot if you like the video and subscribe to the channel so you don't miss out on my next video. As a thank you, I promise you to read and reply to all of your comments. But back to my plans. Because of the high valuation of the S&P, I've also started debating if I should switch my regular savings plan to other more globally diversified ETFs like the MSCI World or the FTSE All World. I've invested into the S&P every month since I started this portfolio, so this would be quite a big change. But I've just started thinking about this, and even if I switch, I probably won't sell my shares of the S&P. And up to now, I have not even started to look into which ETF could be a good candidate for a switch. So there is still some work to do. As I said earlier, I'll also keep watching for opportunities to increase some of my smaller positions. In my last portfolio update, I briefly showed you my watch list and asked if this is something that would interest you in more detail. Thanks a lot for your comments, Watson and Björn. I hear you and you will get the update. Just not today, because some of the companies I had on the list are older ones that I don't want to buy anymore, or at least not right now. But instead, I have some other companies that I find pretty interesting right now that are not yet on the list. So let me update my list first so that I can show you the latest one with all the relevant companies. In the beginning of the video, I also promised you some news. Because I have a project that I have been working on for several months now. And I honestly can't wait to share this with you, but I still need some more time to finish it. But right now, I have arrived at a stage where I can't go on by myself, but I need some help. And before hiring someone from Fiverr or so, I thought that there are some very clever people here that I might as well ask first. So here it comes. You guys probably know by now that I'm a physics engineer and care about statistics and mathematical correlations. So to better implement this with my investment style, I have crunched numbers and statistics, learned about different quant rating systems, and created a stock scoring system based on financial metrics, statistically proven weightings, and of course a touch of my own investment style. This scoring system takes over 30 different metrics into account to rank companies in 5 different categories. The system itself is almost finished now, but I need help to implement this in a nice looking Google Sheets dashboard. If possible, even with automatic data acquisition, so I can easily use it for my stock analysis here. So if you are a Google Sheets expert and familiar with building nice looking dashboards, please feel free to contact me via the email address on my channel page or in the description below. Of course, I also don't expect anybody to do this for free, so there is definitely a paycheck involved. For everybody else, you are probably not as excited as I am, but you can also look forward to seeing this being implemented for my stock analysis as soon as it's ready. I hope to finish this within the next quarter. I have also not forgotten about the Prismian update that some of you requested. Again, sorry for the delay, it is still on my to-do list, but I have struggled a bit to keep up with all the topics I like to cover because my regular job keeps me very busy right now. Just to give you a rough idea, between YouTube and my job, I've been working around 17 to 18 hours per week lately. And if you think that I'm doing this for the sweet YouTube money, guess again. Up to now, I have not earned a single penny from YouTube. Of course, I hope to get monetized someday to get at least a small reward for my efforts, but I am doing this because I like to do it and I like to share my research. The biggest reward I get from YouTube right now is actually the joy from reading your comments. For me, this alone is worth the effort, but of course it doesn't pay the bills. So enough of the rambling. Sorry if the second half of the episode was a bit more conversational as usual, but there is a lot going on right now and I just wanted you to know why some things take a bit more time recently. It will get better soon. If after all the rambling you need some fact-driven stock analysis now, how about this video where I go over 3 unknown dividend growth stocks that could all grow the dividends with double-digit growth rates over the last 5 years. One of them had even a dividend CAGR of 35%. And this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching guys, and see you in the next video.